All right, good evening, guys. Ken at Tortoise Capital. This is the Foundation's Q&A check-in for August 31st, 2023. Brian, I'm probably not going to get to your uh, question on sort of like learning environment because I'm going to be talking about the blended monthly rebalancing, and that might very well end up being the full hour. And so what I'll do is I'm going to answer that as a separate question in a more deliberate way. Um, but the question that Mullen asked me is actually is going to be kind of an involved answer. Uh, so yeah, I'm up to 5 miles a day now on the hour long walk, which is really good. That's 12-minute miles, which is better than the expert infantry badge standard for road marching. Now I'm not carrying a pack and full equipment, but still doing pretty good. I could not have done that before the surgery, so there's a real benefit from uh, what I'm doing right now. The surgery is helpful. You know, my I had about 60% restriction on the valve, so only 40% of the blood and oxygen was getting out, and so I was getting starved of oxygen. So, but there was no blockage in the arteries. It was just that the valve was inefficient. So now that thing is down to like 92% efficient, it's like my heart is used to working really hard, and now I'm getting a lot of energy. So there we are. Let me make sure I've got the recording on here. Yeah. Okay, so Mullen asks for the monthly ETF system, um, and we're talking about the blended monthly rebalancing system when we say that. All right. So this is the BMR, which stands for blended monthly rebalancing. Now, that is a system that is taught in the core system, and there's a white paper. I think I posted that in the foundations course. There's also a number of swing and day courses. There's a basic mechanical swing, and then there's an advanced swing where I get into some discretionary. In the day trading, I teach a number of systems like the frog and the regression line crossover, and then the second generation. Then I also teach a hybrid course, which includes all three of these things. If I can draw it poorly like that, which really shows the commonalities between the fractal patterns and how they fit together into an overall um, multi-time frame approach. And then from that, I extracted what I thought were the crucial elements, the critical pieces that supported all of those, and called that foundations. And that's kind of what you guys are in. Now, in this foundations course, there's pieces and parts of each of those, but not a complete and comprehensive treatment of it. Um, and so it's the problem of abundance. There's so much in there that I want to tell everything, but there's really about 5 or 6 different courses in there, and I've tried to give you just the basics in foundations, and then to help you figure out based on the kind of trader you are, what do you want to do? Do you want to kind of be the longer term position and asset allocation. If you want to do swing trading as part of, part-time trading with end-of-day charts, do you want to be a mechanical trader or or a discretionary trader or a combination? If you want to be a day trader, do you want to do the very, very simplified frog, which is the minimum rule set and no indicators? Or do you want to use the more elaborate systems of, let's say, the sniper or the RLCO pattern? So there's a lot of choices inside there. And the foundations course that you're in is really an effort to help you find yourself in that array of systems and strategies and skills so that you can specialize. You want to be selectively wide and then selectively deep. So I wanted to say that first. Now, so Marlon's question has to do with the system that's in the core. Now, in the core trading workshop, which is I haven't taught that for a while, but the home study course is about 10 years old, I think, with the latest update that VTI has, and it's still solid. What that one does is teaches a number of different strategies. There's one that is there's an asset allocation which says, how do I remain fully invested and properly diversified with an appropriate rebalancing strategy that allows me to get the best possible returns with the minimum risk on the basis of always fully invested and then diversified through holdings? So there's that. Then there's a couple timing models that derive from that are basically a quarterly rebalancing and a monthly rebalancing and a weekly rebalancing, in which we have some population of symbols in our portfolio. And what we're going to do is we're going to evaluate those on a relative strength basis. And from that analysis, we might pick, say, the top 3 and hold them either for a quarter or a month or a week, and then rerun the analysis and then see which one, maybe it's these 3 the next time. And then we rotate among the leaders. So that is a rebalancing and refiguring. Now there's a second part of that where we also add a market classification element to it. We can say there are some times that the market itself is in such a bad condition that we don't want to hold the relative strength leaders, that the market condition itself overrides the relative strength, and so we may have somewhere between 0 and 100% exposure in the market, and then whatever that X percentage of exposure is, we're then going to allocate it into the relative strength leaders, some number of them, based on analysis, and then we are going to rotate and redo that every time period of interest. Now there's a way that you can also break this into multiple systems so that you have some in the quarterly, some in the monthly, some in the weekly. There's one where you can take the monthly and decide that you're going to have 4 buckets of money, and you're going to perform the analysis on a weekly basis and reset the relative strength leaders, but only for 1/4 of the position. So you would run it here on this week, reset those 3, Then the next week you would rerun it, and then you would adjust 1/4 of the portfolio. And in that way, you're getting sort of a blended monthly, but with weekly intervals. And that way you kind of you do pieces and parts. And over the course of an entire month, you will have readjusted your entire portfolio. There's a version of this where we have that when we're in bullish or sideways markets, that you have portfolio A, which features a lot of equities and growth opportunities, and then you rerun those numbers, and then you reallocate asset allocation from portfolio A while you are in favorable conditions. But that when you go to sideways markets, you reduce that to something like 50% into portfolio A and 50% into portfolio B, which is designed for bearish markets, in which we are going to look for defensive plays and interest bearing accounts, bonds or real estate investment trusts or whatever, that we have some things that are better suited for when the market is in bear conditions. And that if I do go to bear conditions, then I'm 100% exposed into the bearish portfolio B. And then when markets get back into bullish territory, I shift back into the growth portfolio. So there's quite a lot of variations on the core portfolio. The size of the portfolio that you're considering also varies. So in our write-up, in our systems definition, I offer 3 portfolio compositions called ETF 13, 22, and 32. Now, ETF 13 is this one right here. And what this does is it considers the world market model, and it has some amount in the U.S. Well, let's see what it has in the U.S. It has the NASDAQ, the S&P, the Dow, the mid caps, the Russell. So it has 5 out of the 13 are in broad U.S. indexes. It has Treasury, so I should actually call that 6 out of 13. And then it has Japan, Australia, the Euro-Asia blend, emerging markets, Japan, Latin America. So it has 6 out of 13 in the globals. And then it has 1 out of 13 in the U.S. real estate, which, although it is the U.S., it really is kind of divergent from the U.S. equities. All right. So what the ETF 13 does is it gives us, I think, sort of the minimum set of ETFs globally and in the U.S. that gives us a reasonable diversification of potential. And then when we perform the analysis on it, we can then try to find the relative strength leaders. Now, it turns out that in the blended monthly rebalancing, in the study that we did on that, we said, what happens if you have a 13 member portfolio and you just hold the top 1 or the top 2 or the top 3 or the top 4 or the top 5, and then rotate that either quarterly, monthly, or weekly? What kind of results do you get if you do that? And then how should we evaluate the relative strength? Well, what our studies showed was that there are times that just evaluating things on a 3-month percentage, the percent gain, is long enough to give you clear indicators to the winners, but that there were also some times you wanted to know who the 6-month winners were. And so what we ended up doing was blending the 3. We took 70% of the 3-month period plus 30% of the 6-month return, and we blended that to come up with this aggregated or weighted average of relative strength performance. And then we ranked things on the basis of 1 to n. And then in the BMR 13, 22, and 32, we hold the top 3 of those positions for 1 month. So in this case, if we were evaluating today, we'd say the 3 to hold are the Qs, the S&P, and Latin America. And now you can see that right here. This was as of Friday night's report. The Qs, the S&P, and Latin America were the 3 strongest members of that ETF 13 portfolio. Well, what happens if you increase the size of that? So what we did with the ETF22, which is a model portfolio, what we did was we added the XL series of sector spiders in the S&P. So we added XLB, materials, energy, finance, tech, staples, discretionary, utilities, finance. I'm missing one in there. Anyway, so the XL series. So there's 9 sector spiders. So if you add those, you get ETF 22. ETF 32 was, hey, what if we added some other more narrowly defined ETFs that represented countries and asset classes like Brazil? Instead of just Latin America, we go Brazil and Mexico and some other things. So we added a few more more specialized but still large indexes. Well, you can actually go as far as you want. We actually include the stats for what happens if I applied this to the 30 members of the Dow, and if I wanted to trade this kind of an approach with the large cap stocks in the Dow Industrials, because in many ways they are actually ETFs themselves. Like if you look at Coca-Cola, you would say that's probably a large cap global blend mature industry, because it has interests in many different countries and regions, has a lot of different holdings, or General Electric or General Motors. So anyway, what we did was we took this methodology and we expanded it beyond the pure mechanical application of the rules to ETFs, and we said, what if we turned a system and used it for information purposes and relaxed it a little bit and called it a strategy? I could now use the same lens that I'm looking to evaluate a strict set of ETFs, and I could look at a broad population, and that's what I do in my weekend report. So all of those things are true. This is one of the essences of hybrid trading. And in our foundations course, I talk about this, which is that sometimes a system, which is a very strict, mechanically tradable set of rules, it can also be relaxed, and it can provide information to inform a judgment about a general purpose strategy. Well, you can see that I do that here. What I want to show you is that the blended monthly rebalancing, whoops, yeah, so the blended monthly rebalancing uses this approach of analyzing symbols in a portfolio using a blend of the 3-month and the 6-month to come up with a way to rank order these. Now, you notice that what I've done is I've also added the 4 color combinations: green, white, yellow, and red. So this is not part of the blended monthly rebalancing, but it's part of the information analysis lens that I use, that you know that this is the average of those members of the portfolio. and that average to plus one standard deviation is going to be categorized as white, and that anything that's coded green is more than one standard deviation better than the average. So it's fair to say right now that the Qs and the S&P are abnormally strong on the blended performance compared to the rest of the portfolio, and that Treasuries, Australia, and Asia less Japan are abnormally weak compared to those same members of the portfolio. Check or hold? Now, so in terms of understanding or applying the blended monthly rebalancing strict system rules, all I really need is that portion of the report, and I only need to know the top three. And then according to the rules of that system basically say that once a month I evaluate the members of the chosen portfolio, in this case ETF13, on the basis of the blended performance. And then what I want to do is own the top three. And then I'm going to judge them on whether or not I can actually own them. And I can only own those if they are better than their 4-month moving average. And so that's what that rule set shows right there. They have to be one of the top three, and they have to be above their 4-month moving average. If one of these was in the top three because it had a high number, but it was below its 4-month moving average, which can happen, then that 1/3 of the portfolio, instead of being invested there, has to go to cash. So what I do is I end up breaking the portfolio into 3 positions. Now let's just suppose, for the sake of argument, that the Qs and the SPY were both above, but that Latin America, for whatever reason, was on a cash. Then this month coming up, I would put 1/3 of my portfolio into the Qs, 1/3 into the S&P, and then 1/3 into cash, and I would hold it for 1 month. I would have a 10% trailing stop, and then during the month, if that 10% trailing stop was hit, then we would exit the position, and then for the remainder of that month, that money would go into cash, and then in October, we would reevaluate the entire portfolio once more. Now, the next part of this was an asset allocation model, which said, no, actually, that for BMR, that's all. That's what the rule set. That's what the rule set says. That I own the top 3, as long as they are on a buy signal. Otherwise, I own cash. Now, it turned out that this gave a lot of useful information, not just on month 1 and then month 2, when I would wake up and run the numbers at the end of the month, and then manage the portfolio. There were a lot of times when that there was intermediate time frame information available. So what I started doing was running these same performance numbers for 1 week and 1 month to inform my view of what was going on in these broad indexes that are driving the world. And then I color-coded them so that I could see how the ebbs and flows of the market would be adjusting on the basis of relative strength. And it turns out that on the basis of 1 week and 1 month information, I can actually turn that into a swing system that uses other rules and other strategies that are different than the specific rules that I use for BMR. And so in this way, the lens that I'm using for relative strength of the world market model, using this analysis method, allows me to do more things than just the BMR. Here's an example of one. Now, there is a system called ETF2. So the blended monthly rebalancing is a monthly rebalancing, right? According to the rules I just said. ETF2 was a weekly relative strength, conservative, timing swing model that was used for some guys that were running a hedge fund, and that hedge fund was sending signals to individual members, and they were following a set of rules that we wrote for ETF2 that used this blended percentage of 3 and 6 month to populate this idea of the strength column. It was one of 3 different indicators that we used to evaluate a much wider set of ETFs. We were actually looking at about 200 very liquid ETFs. And what we did was we were going to hold up to 10 positions. And each position would have an allocation of 10% of the portfolio. And then on the basis of a set of specific rules about how to pick, we would pick 10 ETFs, buy each one for 10%, and then we would have a 10% trailing stop. And then we would stay in that position until this thing went below average, or the 10% trailing stop would be hit. And so if the position was held and then an exit rule was hit, that money would go into cash. And then each week we would take a look at the cash portion, and we would decide if we could allocate that money back into the market. And so the way we would do that is we had 10 symbols, the 10 big indexes of the world, of which 4 were in the US and 6 were globals. And if each of the if the SPY was better than its 4-month moving average, which by the way was also, it was the same signal, then you could invest 10% of your portfolio in the theoretical exposure. And then if all 10 of the ETFs in the world market model were all better than their 4-month moving average, then you could have 100% of your portfolio fully invested. Now, as we stand today on 8/25, only 4 of the 10 members of the world market model are better than their 4-month moving average. So the ETF2 model says that your theoretical exposure is limited to 40%. So here were the rules that we used for that. We took a look at our portfolio. We said how much is in cash and how much is invested. And we said, let's suppose that this week we had 6 positions in because there were 6 strong signals from the previous week. And so we had 60% of our portfolio approximately invested and 40% in cash. And now, this week, none of those hit their 10% trailing stops, and none of them went below average, so we were protected. And now the theoretical model went from 60% to 40%. What we looked at was we said we would never use this number to exit a position that was already justified and was protected by a stop. But what it meant was, because our exposure was greater than the theoretical model, we could not add any of the cash position into the market. But suppose that we had 20% invested and 80% cash, which could happen, and the theoretical model said 40% was appropriate for the week ahead, then what that would let us do is take 20% of our cash and deploy it into 2 positions that were at the top of the stack. And then we had a set of rules to decide which of these indicators we were going to follow. We looked at strength, consistency, and quality. Now, it turned out that the blended percentage is the analysis that we use for strength. It's a pure relative strength analysis. Consistency was we looked at the rolling 10-week average of strength. So if you had this week, week 1, had strength, we would then look at the last 10 weeks, come up with a weighted average of that, and then that would be the consistency rating. So if you were consistently strong, you got a great number on consistency. Now, maybe you weren't the strongest, but if you had a strong consistency number, that gave you a benefit. And then in terms of quality, what we did was we evaluated a system quality number for each of the members of the 200 symbols in the ETF, and we ranked them on a scale of 1 to 100. And so each one of these indicators were ranked on a score of 1 to 100 and then averaged. And then we used those indicators to come up with the rules about which symbols we were going to evaluate. So that's a very long and elaborate story to simply say that one method of analysis or a model of analysis, in this case, a proprietary form of relative strength on the basis of blended monthly performance, could be used for a very strict set of, for a system, such as the BMR, that could also be a component. It could be one component of another system called ETF2, which had different rules but was using part of that methodology. Now, even in a more relaxed state, I want you to see that what I have here is a set of strategies for swing traders that can use some discretion. And now what I have is, as you know, I evaluate these strength, consistency, and quality on a scale of 1 to 100. I color code them. And what I use for a strategy is I look at the combination of strength and consistency. Like, I don't use the system quality number for this strategy. But what I do is I take a look at 4 different categories of, or 4 buckets. There are symbols that are clearly leaders. Like something that is green on strength, it has a current relative strength that is high. Something that is green on consistency has been a leader for 10 weeks. That's really good. So my assessment is that that thing is great. And if I wanted to do a swing trade on that as a candidate, like if I wanted to look at the Dow Jones U.S. Oil and Equipment Index, IEZ, that thing is it is the very best symbol in the stack. So I could simply target that and reinforce. If I were to look at that on a scale, it's going to look like that. So if I see a little dip, I could just get into it with a 10% trailing stop and just buy it. Or I could use one of the sniper patterns. But these become things that are in the green are very easy to trade on a swing basis, and I can trade them on a intraday basis with a turbo because they're winners. So if I saw home builders or oil and gas exploration or oil equipment on a day where the market was up and XLE Energy was up and XOP was even better, I can turbo trade that with no hesitation because all signs point to continued strength. Another form of leader is something that went green on strength this week and over the last 10 weeks has only been above average. What that means is something that if this was average Over the last 10 weeks, it's been above average, but now this week it's even better. There's an acceleration going on here. It was good, now great, and here's a chance for my strategy to exploit new strength. This might be a way to get an even better move. So I actually like green and white. That tells me this week I should be looking at oil because it is green and white. By the same token, energy is green and yellow. It was below average the past 9 weeks, but this week it got very, very strong. So energy is really on a tear. So you can now see, I hope, how I can go from a very strict, rule-based, robo-traded system of BMR and create some strategies out of that. I can actually expand the portfolios to include a much wider set of ETFs and even individual stocks. I can use it to come up with swing strategies. I can use ETF2 to do a weekly hedge fund that incorporates strength, consistency, and volatility adjusted strength. And I can come up with a whole series of ideas off a single common way of evaluating relative strength in a proprietary method. So the method that I use to calculate those numbers is proprietary. I'll reveal it to you, of course. But it gives me a unique and personal insight into what's going into the market. It's informed by statistics, and it allows me to have freedom of cognitive decision making, if I can say it that way. Freedom of information. That it gives me a unique set of insights. So I needed to say all of that in order so that I could come up and answer Mullen's particular questions. I can't teach you all those systems in 1 hour. It takes a weekend of just the core system to teach you the blended monthly rebalancing. It takes the swing trade course to teach you all the nuances of mechanical trading. The hybrid swing trading course does hybrid, but I needed to at least answer those parts of the question. Now, specific to Mullen's question, he asks me now specifically, do I advise running or ranking these at the end of the month, like 8/31, or is it always Friday's closing along with the weekly report? Well, here's what we did in the research weekend. We actually studied the heck out of that. We said, what happens if you waited to the last day of the month, and what if you rebalanced 1 day earlier, or 2 days earlier, or 3 days earlier, or 4 days earlier, or 5 days earlier, or 1 day, 2 days, 3 days, 4 days, or 5 days? What we found was that if you blended, or if you did your adjustments 2 days before the end of the month, or 5 days after the month, you actually got a benefit, small but measurable, but that the benefit you really got was from doing the monthly reallocation and using the asset allocation rules that came out of here to preserve your gains. So there was some small advantage to going a couple days early. That turned out to be the best way. And the reason being was, if you had a month-long outperformance in a symbol, and then other people were going to rebalance into the winners, then if you did it 2 days early and they balanced when the money came into the portfolio and they added a bunch of new money, you were already in the position that they were buying, and then you would get the benefit of their buying. We also saw that if you only invested between the second day before the end of the month and the 5 days after the first of the month, those 7 days, you got 80% of the value of the entire month, because of what happens with people that are getting paid every 2 weeks or every month, and they get a new pile of money and then that money goes into their accounts and dollar cost averaging. So there's a periodic buying pressure that happens at the end of the month and halfway through the month. So if that money comes in here between 2 days before and 5 days after, you got the benefit of that boost, and then the rest of the month you were free from volatility. So we did that. That was one of the things that we studied during the annual research weekends. So what I generally advise is as long as you religiously rebalance systematically, you're going to get most of the benefit. But if I had to choose, I would pick 2 working days prior to the end of the month and do my rebalancing right there. There is a micro advantage to doing that. Okay? Now, the weekly report that he's referring to here says, I perform this every week, not every month. So what I do is I take the, let me get you the ETF 10, stand by. So there's 10 members of the ETF2 council, if you will, the world market model. Let me find those real quick. Whoop, I'm sorry. So you see this on page 11 of the weekend report. So this page, which is page 10 in the weekend report, the ETF regional report, the 10 regions of the world market model. This represents the analysis model for that hedge fund report, and that thing is still going strong. By the way, we're about 20 years into that system. So you'll notice that there are 10 ETFs in there. There's 4 in the U.S. The S&P, tech, mid caps, and small caps. And there's 6 in the globals. And I run the 4-month moving average filter on each one of them. Now it turns out that as of last week, 4 of the 10 were on buy signals and 6 of them were on cash. So what that meant was for this week coming up, the theoretical model was 40% cash and 40% invested and 60% cash. That is a governor that tells you, am I allowed to add more money into my existing positions? Because remember, we have some number of open positions in that system. Open positions. And each one of them has a trailing stop that is appropriate for that symbol. And we trust the trailing stop. So we will never exit one of these positions simply because the world market model showed a little less risk. Because we have our trailing stop that protects us. But what it does is prevents us from adding cash into new positions if it would exceed the theoretical model. So that's how we interpret that. And I provide a summary of that on this weekend report. And on this particular week, last week there was 6 of the 10 ETFs were above the 4-month, and this month there was only 4. So that actually means that the market got a little riskier, and we should be cautious. If this was 100%, then every one of those 10 global ETFs is doing well, and we could invest with complete confidence. Now, I have used this number to generate some other ideas for strategies about what to do when that number goes to 100% or down to 0% cash. I mean, I'm sorry, to 0% invested and 100% cash. There are some short term tactical strategies that are appropriate for that kind of a market. So that's what this is adjusted weekly using those 10 members of the ETF. You could actually look at that set of ETFs, and it gives you a nice rule of thumb on where your money ought to be. Like right now, what's really working is the U.S. That's what's really working right now. This is the same lens, but now I'm looking at the S&P sector spiders, and you can see that what's really working is those three: energy, tech, and consumer discretionary are all better than the daddy rabbit of the S&P. What's really bad is utilities and staples. You could also look at this broad asset allocation and say, look, right now treasuries are, S&P is really, treasuries are getting smoked. Real estate, commodities, and gold are bad. Only oil itself is much better than the S&P. So you're actually better off right now in equities than you are in some of those alternative hedges. So even when the market feels relatively weak, there's no safety to be found in these traditional hedges. You'd actually be losing money if you were using those defensive plays to protect you against the risk of equities. So this is a way that you can actually test some of those heuristics. Now, this world market model over here is an even wider look that takes these members of the world market model. Like you can see the Dow, the S&P, tech, mid caps, small caps, Japan, Asia less Japan, the Euro-Asia blend, Latin America. But now it actually gives you a breakout of some other opportunities. So you could drill down into Mexico, Brazil, and Canada if you wanted, or the countries of Europe, or the countries of Asia, or some of the other asset classes altogether. And now using that same lens of the strength column, I can now get a radar screen that tells me what's going on in the world at a glance. And I update this weekly in order to give myself insights into what is going on. Now, when I come over and I look at that same ETF blend, the ETF2 model, where I was getting the blended monthly rebalancing, and I was using, as you know, the 3 month and the 6 month. By adding the 1 month, by adding the 1 month, getting mouse drift here, adding the 1 week and the 1 month, I can actually see some things happening, like the Dow is above average on 3 month and 6 months. It's in the fourth position. It actually had a pretty good 1 month by only losing 2.5%, but it is actually underperforming this whole week. So this is the case of the Dow doing bad, but tech and Latin America doing much better. And then I can actually see how treasuries, which have been doing really poorly, actually had a 1 month or 1 week boost. And so there may be a tactical trade, not a long-term trade, but I might be able to squeeze a 1 or 2 or 3 day trade out of treasuries simply on the basis of this. So I'm using the lens of this relative strength to inform a lot of different systems and strategies. In that sense, it's fractal and very efficient and consistent between different systems. Let's see. Um, let's make sure I answered all his questions here. So I think I just answered that right here. That it's not the previous month's report that says that, it's actually the previous week, where the theoretical exposure of ETF2, which varies every week. Now, the next thing is that ETF 13, 22, and 32 are three different portfolios. They're not looking at different look back periods. They're looking at the same 3 month and 6 month. It's just that ETF 13 consists of these 13 core ETFs that I then add the 9 sector spiders like XLE and so on to get a deeper look into and differentiate the elements of SPY because they are very, very liquid. And then I add another 10 countries and regions and sectors so that I get more volatility. Now, in that sense, ETF 13 is a conservative broad index. ETF 32 is more volatile. What's even more volatile than that is if I look at all 300 ETFs in the ETF Max database, or the top 200 liquid ETFs, or I look at the Dow 30, each of these then is a strategy. If I wanted to just find the relative strength leaders in those populations, I might then be able to go drill down and look at relative strength swing trading. So that's the answer to that question. Sorry. So that's everything that I want to say. So I've thrown a lot of things at you. Absolute did. What I want you to understand, I'm going to go back and just sort of summarize then and say where we've been is that come on, Kenneth. So, in the foundations course, we're looking at a set of common ideas and principles that goes to inform long-term core portfolio, which features things like asset allocation, annual rebalancing, quarterly rebalancing, monthly rebalancing, weekly rebalancing, and it informs things on swing trades, which are like mechanical and discretionary. And then in the day trading, there are things that we look at in terms of simple rules like the frog, or complex rules or strategies like RLCO, or hybrid forms like the sniper. And then there is hybrid trading, which really looks at how to blend all three of those different time frames into one overall blended approach to trading in all time frames based on a set of standard principles and fractal patterns. And that one of the most important elements of that is the idea of relative strength and the use of this tortoise index, which comes out of the blended 3 month and 6 month, which is an essential part of the core, and which also features as the strength indicator for ETF2 and my tactical market scenario evaluator. And that's how all of this stuff fits together. Okay? So that's about as far as I wanted to go. I want to make sure that I was as clear as I could be in that. And then ask if you have any specific questions about things. Like now, I notice that Greg says, if the basket is heading in one direction, but the turbo's in the same direction, then that could be a mover. Yeah. So one of the ways I do that then is, let's suppose that I have let's suppose that in my overall portfolio, when I look at the core and swing and day trading, I allocate my money in this way: core, swing, and day. I only keep about 20% of my money in the core because I only rebalance that once a month. Because I use the swing trade to protect those things that are in the core. Because I'm only going to do that once every month. So there could be 4 swing adjustments, and then the monthly adjustment happens. So the little swing trading adjustments that I can do weekly are ways to either, I can take something that's in a core and it's going up this week, I can put a turbo on that so I get an even better benefit. But what if next week it's going down? Well, I can use a swing trade to hedge against that and protect the core. I can reinforce it or protect the core on the basis of what is it doing from week to week without monkeying around with the long-term position that's in the core. And sometimes swing trades become good enough during the month that they end up becoming core positions for the next month. Where it started off as a swing trade on week 1 and it just kept going and getting better, and then it was strong enough to be now added to the core portfolio. That's the same way that I use swing trade signals to help me pick really good intraday targets. So I put 40% of my money in day trading, no overnight risk. So the most overnight risk I ever have would be 60%, and that's if I was fully invested with the core and fully invested on the long side in swings. Then I would be at 60% exposure. But if I was worried about a critical state, I could use leverage, and I could use the 40% of the money that's in the day trade to get a leveraged hedge position so that I could be market neutral overnight. Exactly. So I have decided personally that 20-40-40 is the right way for me to allocate my assets between core, swing, and then the way that I blend those together, I simply think of as hybrid trading. Sometimes the swing is informing the core or protecting the core. Sometimes the swing is informing or protecting the day trade and so forth. So this gives me an integrated look at all of my trading. Check or hold? Okay. Yeah, so that's everything I wanted to cover for tonight, Brian. That's why I didn't think I could get to the, the learning system and learning ecosystem. I wanted to keep that for a separate, fresh. Now, what I'm going to do is, I believe there's a white paper in there called the Blended Monthly Rebalancing in the Foundations course. I'm going to make sure that it's there, and that you can download it from the introductory. It gives you the specific rules for BMR, and it gives you specific rules for the ETF2. Those are 2 separate systems. Like the BMR. Yeah, so BMR is really a monthly rebalancing. And ETF2 is a weekly swing. There are some commonalities between them, but those are really two separate systems. There's a lot more work that goes into ETF2, whereas blended monthly rebalancing and blended quarterly rebalancing were intended to be fire and forget and minutes a month or minutes a quarter. ETF2 required about an hour each week and taking actions on Mondays and then managing, watching the trailing stops during the week. But I will make both of those rule sets available to you. Okay? All right. And I'm going to hang those in the foundations course. I think they're there now, but if not, I'll put them there. All right. Take good care. That's everything I got for tonight. Mullen, did I answer your questions? And the final case was, yeah, there's a strong correlation between those three because they're all using exactly the same methodology. It's just that one like ETF 13 and then ETF 22 is those 13 plus 9, and then the other one is plus another 10 to get to ETF 32. You can actually, if you go to ETF Replay, they actually, for about $25 a month, there's a pretty nice little back testing tool that's on there that allows you to run an infinite number of variations on portfolio composition, how much blending to do and what percentages, and what numbers to hold, and what's your threshold for your filter. We used to run about 300 different models and update it every year. And what we found out was that the 3-month, 6-month, the 70%, 30%, and using the 4-month moving average was so good that it was just better just to stay with that. So, yep. All right, that's everything we got. So I'm going to get this published and posted, and we'll be ready at 8:30.